Joining me now is Stephen Ricchiuto. He's the chief U.S. economist at Mizuho. Steve, it's good to see you. And what do you think the market's message is here? Is it pretty clear?
Well, I mean, I think that the thing you have to take away from even Rick's previous comments is whenever the Fed lets the markets determine what's going on, it blows up in their face. Alan Greenspan allowed the markets to self-police themselves. We had the financial crisis. If the Federal Reserve is going to let the markets tell them where short-term interest rates should go to bring down the rate of inflation, they're going to have a very, very disappointing growth environment. And their concept that we can have somewhat of a soft landing, getting to 1.7% growth this year is just completely impossible. Our numbers are about 0.4% fourth quarter over fourth quarter. That's 1.3% below the Fed. Given what they're doing, where forward rates have to go to validate the dots that they've put in, and they will do this, this Federal Reserve is creating an environment where growth will probably average between minus 1.5% and positive 1.5% over the 5 quarters from the first quarter of this year through the first quarter of next year.
But the issue is not about keeping us out of recession, is it? It's really about taming inflation.
Well, the reality is a lot of this inflation is not inflation the Fed can control. And the Fed has taken the guidance of, well, if they can't control food and energy prices, which they can't drill for oil, they can't raise crops, they're going to collapse the price of all other products so on aggregate inflation comes down. That could lead to a very, very disappointing macroeconomic environment. And for a lot of individuals who've been caught in the squeeze of higher energy prices, higher food prices against incomes that are not keeping the pace with inflation, now you're going to jeopardize their jobs. It's double jeopardy for middle to lower income households, and that's the Fed's cure for bringing inflation down to their target.
Sure,
it's questionable to me whether that's the right way to go.
But if the inflation is just a food and energy problem, why do we have 11 million job openings? You know, why did home prices soar to records? Why are rents accelerating?
Yeah, I don't believe the job openings numbers whatsoever. We don't have much history to understand what job openings really tell us. We had job openings that were substantially above hirings before the whole COVID environment. Now we have more. We don't know whether those numbers are real, what they're really trying to tell us. We have very limited data on it. To go back to your question with regard to why home prices are up and why rent prices are up, remember, COVID created a huge adjustment in people's living patterns. It is a one-time permanent adjustment in how people are going to live because we have suddenly created an environment where work from home is a realistic alternative to working in offices. And there are going to be effects that creates in terms of the inflation indices that are created. Is it a sustained inflation like we had in the 1970s, or is it all a part and parcel of a one-time permanent adjustment in prices that gets followed by a much lower inflationary environment on the other side of it? I think it's a one-time permanent shift, and therefore it'll be reflected in one-time permanent adjustment in the prices of those goods.
The sustained inflation, though, could come from the labor market and from shelter, let's call it. So do you see any signs there that we're not going to have something that pushes wages still around a 5% level year-end? Rents, as I saw in J.P. Morgan's note the other day, they think rents could be 7% come January. So those two categories are the bulk of core inflation, and they both still seem to be pointing higher.
Yeah, you have to keep in mind that there's a lot of other factors besides rents and considerations like that drive the overall inflation environment. Look, rents are important, but the reality of the situation is with regard to rents is we've had environments where we've seen rents go up before, and they do not create a sustainable movement in the economy. Because if incomes are not keeping up with prices, you cannot get permanent upward movements in rents. In addition to that, with the slowdown in the economy we're envisioning, which is substantially greater than the slowdown in the Fed, the labor market is going to ease up. As the labor market eases up, the price that is paid for labor is going to come down, which then works its way right back into the rents that can be paid. Will it all happen in the time frame that the Fed wants? Probably not. But let's be honest, the Fed undershot inflation for over 15 years. We're going to have a big overshoot for 1.5 years. If it extended for 2 years and didn't create the kind of economic stress we're going to develop as a result of the Fed's policies now, so be it. It made more sense to allow that to happen than to basically leave households with less real disposable income after COVID than they had prior to COVID. And that's what their policies are going to do.
All right, Stephen Ricchiuto, we'll leave it there for now.